Banking Book Webinar Series 3, Episode 1, Risk and Operations Model Risk Management, presented by Banking Book Analytics.
So welcome everyone. This is our first episode of our third webinar series, and it's on risk and operations. Today the topic is model risk management, and I'll be a moderator. My name is Paula Saad. I'm a Chief Commercial Officer at BBA, and we have an awesome expert panel on this. John Barris from DeFi Management Consulting, also a collaborator with BBA, and Papawa, he's our Senior Advisor, Suhail Farouk, our Chief Executive Officer. So this is the first one of this year. The next one will be on July 8th, reimagining branch one brick at a time. And the third one will be finding best deposit customers when rates are low, and that will be in the fall. We have a couple of housekeeping items. So please read through, but basically this will be recorded. And you can send your questions to paula@bba.to or just put them in the chat. Also, in the end of the sessions, you can, I'll announce, which email. We can also use this email later for if you have any questions, or I'll be providing with a couple more resources for that as well. With that, I'd like to introduce Suhail Farouk. He is our CEO at BBA. And Suhail, take it away.
Well, thank you so much, Paula. So before I begin, let's just put in a few words for Banking Book. BBA, we set it up in 2018 with the objective of developing automation at financial institutions, specifically at mid-sized financial institutions, focusing on three specific domains and their overlapping activities. And these domains are finance, treasury, and risk. We've had great success to date. We have clients who are using our applications for capital management purposes, for stress testing purposes. We also have recently have our capital management application reviewed externally, and also the results and output for our application were accepted by the regulator for ICAP purposes. And so it's been a very interesting journey. On the development front, we continue to develop new applications. As I said earlier, our capital management applications are in production. We are also developing applications around model risk management and cyber risk management, where we are actually, specifically for the cyber, we are integrating the cyber related, the technological side of cyber risk, as well as the data analytics side of cyber risk to bring it to a common unified language for the entire organization. We issued a paper on cyber, which is published on Global Risk Institute's website. So please feel free to have a look at that. In addition to that, what we've experienced is that although advisory is not our key focus, but what we've experienced is that once we engage with the clients and they see the value in our products and our solutions, we do sort of tend to assist them with transformation, with change management, and other sort of ancillary areas with regards to advisory and consulting services. Thank you, Paula. A little bit about myself. So I started off within the context of today's webinar. I started off back in '97 as a user of models at Scotiabank, and I remember it is pre-KMV time, pre-Moody's KMV times, and the models that we were using were really basic. They were essentially factor-based models, very qualitative in their approach. And we would come up with a numerical or an ordinal rating, spreading over 1 to 10, 1 being the best and 10 being the worst obligor. So since then, I switched to model development side, and that led me into model validation side. So As a model validator, I've worked with over 50 financial institutions in assisting them with model validation, both here at BBA and in my previous roles. Some highlights of model validation relate to validation of IFRS 9 model which was developed by Central One and the team, which assisted Central One, comprising over all big four accounting firms, and ongoing model validation with regards to our existing clients and so forth. So without further ado, I'll pass it back to Paula.
Thank you so much. So I'm gonna ask, so our special guest today is John Veres, CEO of Delphi Management Consulting in the US. So I'm gonna invite John, can you talk a little bit about yourself and your experience in modeling?
Sure. Hello, everybody. So I'm currently the principal at Delphi Management Consulting. We provide advisory service related to treasury, risk management, operations for banking and financial service firms. I've got over 20 years of experience in risk, model risk, capital management. Prior to Delphi, I was the head of capital planning at Santander, where I was responsible for implementing production of risk quantifications for capital planning purposes. Throughout my experience, I worked across multiple areas of finance to advise on modeling strategies, modeling development, model risk tolerances, and risk quantification. Specific to modeling and MRM, I've worked in all areas of modeling, of all areas of model risk management, ranging from developing models, validating models, running quantitative teams, establishing model risk management groups and governance structures. I was responsible for the CCAR delivery over at State Street in Santander, and I've helped a number of clients deliver their CCAR and DFAST submissions. I've worked with many different types of models, credit, PPNR, deposit, stock selection models, economic capital, ALM, anti-money laundering models, and others. I have extensive experience with in-house and vendor calculation solutions such as QRM, Moody's, Bankware. My team and I were one of the first people to work with Bankware, and we helped them establish their economic capital model at one point. So it's funny because everywhere I go and they're using economic capital, it's kind of like, hey, I know exactly how that model works. I put it together. So it's interesting.
Very wow. It seems like you've been, working with modeling for a very, very long time, which just seems like it's something new, but it's not. So thank you for that, and I'm really glad you're joining our team. And last but not least, our senior advisor, Mr. Andy Papala. Andy, please.
Thank you, Paula. I'll be very brief. On my extensive background is somewhere on the website, but basically, from my perspective as a former regulator, we as regulators were always interested in how models were developed, built, validated, and then how they worked, because in many cases those models were a key component of the risk management and risk appetite setting process for institutions. If they were not correct, if they were not validated properly, they could cause problems from a regulatory perspective. So it's been our, my experience in that regard. And more currently, I've been sitting on boards of directors of financial institutions. And of course, from a governance perspective, we start asking questions about how do we know that these models are working properly? What processes are in place to give us that assurance? And we'll be talking a little bit about that today. So I'll pass it back to you and we can get started.
Thank you so much. We had a few people just joining us. So welcome everyone. We are recording the session. Also, if you have any questions, you can send it to Paula at bba.to, or please just put it in the chat. And we're going to have a little bit of a different format on this webinar. It's going to be almost like a fireside chat where everyone will be getting their input. We won't have PowerPoint presentations. And so just jog it there and we can go, as we go along, we can answer those questions. So I'll start maybe with you, Suhail. Why don't you set the stage and share your perspective on model risk management?
Well, thank you so much, Paula. And I'll begin with sort of defining three different waves of models that we've seen in post-Basel II world. So if you recall, for those of us who were experienced enough, back in 2004 when Basel was issued, there was a flurry of vended models and vended solutions which were sort of developed. And then I like to actually move to the second wave, which is post 2008 credit crisis. And that brings us to the third wave, which essentially is the current day, where we're looking at AI-based models, machine learning-based models, and use of applications which are perhaps more driven at using the training data as opposed to really the structural development of models. So let's start with the wave one. But before we begin, um, I think it's important that we can define what a model is, and essentially, model is a mathematical relationship between independent variables and a dependent variable. And what we do in terms of coming up with an output is that we apply that output for making some important decisions with regards to making a lending decision, attaching capital relative to the risk measure of a certain risk type, or assigning a certain pricing, and even taking some important strategic decisions. So from the perspective of regulators, these important decisions, they form the basis of defining the model. Now, of course, in today's world, we can have some reporting framework that can be used and applied for. We would not consider that a model. We can rather call that an application, where essentially a report is being generated for the consumption of the audience inside or outside the financial institution. So in the wave one and pre 2000 and post 2004, where Basel II was rolled out, what we saw was a flurry of vended models. And a lot of the times, the data that was used to develop these models was essentially not the internal data of institutions. It was essentially data that was either pulled around externally, or data that was actually used as a benchmark. And hence, what we saw was models which were relatively opaque, models which were construed more as a black box, and a lot of the times the methodologies relating to those models were not shared by the vendors. Those models that were developed internally were also subjected to some benchmarking and so forth. So fast forward to 2008, what we are seeing now and post credit crisis is that there's increased focus in removing the opaqueness associated with the models, developing what we would call the glass box models, where everything is transparent. Methodologies are sort of developed relative to the statistical principles and machine learning and so forth, which can be tested at the time of development of the models, and which can be validated post sort of development of these models. So that sort of is the framework that we would be focusing on. As you know, that into the post 2008, the regulatory scrutiny of models testing and model validation is becoming increasingly important. Here in Canada, we have OSFI's regulations with regards to enterprise-wide model risk management for deposit-taking institutions, which requires at least model validation for once by second and third lines of defense. Then in the US, Federal Reserve has SR 11-7, which is really a centerpiece and also forms a bulk of model validation and testing, not just for the US-based financial institutions, but also for the Canadian institutions which are engaged in activities south of the border. Now, that being said, this is, of course, the regulatory view or regulatory dimension of model testing. Why don't we look at the business dimension of model testing? So for a moment, if we can think of models as a car which needs a regular tune-up or which needs a regular inspection, I think it would make sense for us to think of models as not just the assets which are producing results by providing an input data, but also from a time to time, we need to be able to look under the hood, identify, what are the potential challenges that we're facing with the models? Have those challenges been addressed? Are the results produced by the model in line with the intuitive expectations, or they're potentially subject to some scrutiny? So if we continue to use models in their opaque form, what would end up happening is that we would end up making wrong pricing decisions. We would end up making wrong lending decisions. We would end up classifying the good loans into bad loans unintentionally. And all of that can continue to happen if these models are not tested. So you can imagine this being done at a systemic level, which can lead to a systemic technological risk. So from a regulatory perspective, and Andy would of course talk about that in a moment, but from a regulatory perspective, what we are looking at a potential ticking bomb, which can actually have another dimension associated from a systemic risk perspective.
So yeah, so I guess not only in the regulator side, but also making the wrong decisions can cost a lot of money to these organizations for them not to have the proper modeling done. Before we continue, I just want to take everyone's attention. We launched a poll. Is on the right hand side of your screen. There is the participants, there is the chat, and there's a triangle, square, and a circle. If you go there and go to the poll, we have a question for you there. Most people here, if not all, are from banks or credit unions, financial institutions in general. And so if you go to the polls, there is a poll in that what are your organization's model risk management pain points, and you can choose one of those. And we're going to go, and it's live already. And by the end, we go back and we're going to answer some questions on how those can be remediated. Continuing. I would like to get John's attention. So thank you, Suhail. John, how would you describe the difference between the current emerging validation practices at financial institutions?
So, so current model validations have their challenges, as we all know. Many companies are validating models in-house, and they're seeing a lot of issues around resources, workflow, the ease to which they can interpret a model. Additionally, there's a lot of challenges when it comes to data, timing of a validation, timing of review, consistency of the review across the group, maybe consistencies of how the group is measuring model performance. There's a lot of subjectiveness and biases, and the ability to have like objective resources. So there's a lot of challenges today in today's environment. Fortunately, we're seeing a lot of a shift towards more sophisticated technology, as Sohail mentioned. We're seeing a move towards artificial intelligence, machine learning, and other natural language processing tools. As these tools become more mainstream, I think they're going to play a vital role in the future of model development and validation, by leveraging efficiencies, consistencies, and ultimately removing subjective biases. I think what's driving this evolution is and I think Sohail mentioned earlier, is really the need for explainability or transparency, which is really being demanded by regulators, CROs, but ultimately I think it's being demanded by model users and owners in their ability to defend their results. I heard, Sohail, in one of the conversations we had prior, I heard you use the term, AI today will help us, or the validations of models using AI will help us move away from maybe a black box model to more of a glass box model, and it'll provide a more consistent approach to model development and validation activities. I think to help model owners, provide them more transparency and accountability. And I think more important than just normal AI is more explainable AI. I think you mentioned systemic risk. And I think if we don't have more explainable AI, I think we will be running into some type of technological risk with AI. Ultimately, AI is going to be a critical element in meeting future regulations. And ultimately, I think using, explainable AI, we may slowly start to prevent some of that systemic technological risk that you mentioned.
Paula, I think you're on mute, Paula.
Of course I am. I was waiting for that to happen. Okay, so sorry. So anyway, let's move on to you. In your experience, what have been the continuum of model validation process and the role of independence in validation?
Well, as Sohail and John have already pointed out, this is a challenging area for most organizations. One of the big things is understanding the process of which models are built, who builds them, and how they're built, and then understanding who has the capacity internally to be able to come along and validate that. So it's a whole mishmash, I think, of processes. Starts with management. The first line of defense is really good people on the ground with understanding how the models are structured. And one of the challenges with management, of course, is that they're invested in those models. They've built them, they understand them, and they use them all the time. So we look at it and we start saying, from a management perspective, does management do any back testing? Does management do any testing of its own to validate that? Then you move on from management to, say, the risk management people that come in and oversee this stuff, the second line of defense. And then you ask yourself the question from a risk management perspective, if you're the CRO or someone else in the organization, how do I know that this model is meeting our standards internally? And then you might involve the internal audit people who may have or may not have the capacity and understanding of models to validate in some fashion or test some of that. And then finally, you get into this whole area of external resources. You bring in consultants or external resources to say, we've got these models, we need to have someone look at them, and we need to have an understanding of whether or not they're doing what they're supposed to do. So you have this broad, validation process. And from an oversight perspective, management and the board and committees of the board, for example, they have to rely and they have to understand the process for that validation, sequence. And then they have to also assure themselves that those validators are independent of management to some extent. And independence is, in the eye of the beholder, I guess, to some extent. So, from a regulatory perspective, the regulator oversees all this stuff and says, okay, I need to know who's built the models, how they're validated, how independent of those validations, whether they be internally or externally done, and then how can I, as a regulator, rely on that validation process? So it's a whole continuum of questions that regulators will ask to give them that assurance. And when they don't get that assurance, when they come back and they say, we don't think you're doing things the right way, the question then for the organization is, what do we do now? How do we provide assurance? How do we provide comfort to the regulator that these models have been looked after carefully all through the process? And that's when the trouble starts, because that's when the regulators start breathing down your neck saying, we need this and we need that and we need to see this. And that's when you call people like John or Sohail and say, help us, because we need to have some validation process that's independent, that's transparent, and that's reputable to solve those issues. So.
And those regulators, they also start looking at other things once one thing is not right. Is it like a snowball into other things they will look at because they might not be right as well? Is that another consequence of not having, being looked after and auditing the models the way it should be?
Exactly, and that's a great question, Paula, because confidence, regulators have confidence in organizations that can demonstrate they have all these processes in place. And our friends in Canada and at OSFI and the provincial regulators will ask those questions when they come in to do their examination work and inspection work. They're going to ask the questions, how do we know? How do we know that you have done all these things? And you have to prove it, document it, and prove it. So from that perspective, I think we're moving in the right direction because we've got experience in other areas like this. But there's still, I think the growth and the maturity has got a long way to go yet.
Okay, got it. Thank you so much. John, let's go back. You mentioned the systemic technological risk. Could that be an intended outcome of applying AI, and that we are again being pushed even more in the opacity of the models?
Yeah, I believe so. A lot of financial institutions that I've been visiting or doing work for, they started bringing in AI-driven validation to some extent. And I've heard of some vendors doing this as well, and I've kind of looked into this a little. And between the institutions and the vendors, they're slowly transforming this validation sector. But with that lunch, they're bringing a lot of problems due to transparency, accountability, and a lot of complexity. And I go back to the need for the explainable AI technology. I don't know how familiar you are with this, but in the United States, the U.S. continues to pursue what they're calling algorithmic accountability rules and laws that require companies to use AI to conduct like automated decision system impact and stuff. And what they're looking for in these rules that they're passing, they're trying to make sure that there's lack of issues regarding accuracy and fairness and bias and discrimination and privacy and security. So there's a lot of that already trying to happen here in the U.S. And this transparency is going to come into play and add more fuel for the need for explainable AI technology. It's only a matter of time that's going to be the push. Something to note too, that a lot of these companies that are using these technologies now, they're not using more of an explainable AI technology, and they've invested heavy costs and dollars into this right now. Mm-hmm. And moving to more of an explainable AI technology is going to cost them a lot of money to retrofit what they have. And a lot of companies might have to roll back some of their implementations in order to make these changes. But I think they can reduce that systemic risk that you're asking about.
John, on that point, if I could just jump in and ask you a question to clarify, what about this whole issue of intellectual property rights, in that context of building these algorithms and everything else that goes with these models? How do financial institutions and other organizations protect themselves to make sure that all that work that's been invested and done and performed is not tampered with by other organizations or stolen?
Yeah, Andrew, that's a great point. I think a lot of firms are struggling with that, and they're trying to keep a lot of these models that they really don't want other people understanding. They're trying to keep that in-house, but that alone has its problems, as we mentioned. There's resourcing issues. There's biases, how people create, how they validate these models. Again, you have a lot of managerial biases as the outcomes of these validations. So I don't have a good answer for you, but I do know that companies are struggling with this, by having these models that they're not allowed to really let go to other outside institutions yet.
Oh.
Thank you.
Yeah, that can be very costly, I guess, for the companies where they're not allowed. They have this old models that they can't really. They're not serving them anymore, but on top of that, they are not, they're not innovating. They're not moving and making that investment. They end up just fixing the old one instead of just implementing a new one. That's what I like. We heard a lot about that.
Andrew, what makes this particularly difficult for some people is a lot of these companies are embedding third-party pieces to their models, which makes it overly complicated. They have pieces of these Moody models within their models and vice versa, and it really complicates things.
Yeah, I've had that experience. One of the boards I sit on is a small bank, and staff management was trying to explain to me how they incorporated various 2 or 3 different models into one application. Right. And they lost me after hello. I just one of the issues is trying to understand this stuff, right? So, thank you.
Thank you. So, how any comments?
I think it's a very interesting conversation, and quite frankly, as we serve mid-sized financial institutions, it becomes extremely important from our perspective that the dollar that they invest in developing or acquiring the models goes a long way. And if you look at the vendor landscape, it's not tilted in favor of the users. It's tilted in the favor of the vendors. And quite frankly, as I said earlier, that if the models are developed based on an external training data, which is not relevant really to the institution that is using the models, then not just they end up paying huge amounts of fee or invest a lot of money in acquiring these models, but also are being subjected to the use of models which are not really developed for the products that they want to run through the models, for the data that they want to run through the models. And a lot of the times when they've invested so heavily in these type of models or acquisitions, these models end up becoming sort of the holy artifacts in the organization. And their decisions, which are developed by these models, are taken at the face value with limited inside knowledge of how this model is working. And of course, that would cause a double whammy from the perspective of the user of the models. So it's really a cautionary tale from users' perspective to be able to look at the models before they acquire, understand that it is fit for purpose, and can also be used from business as usual perspective without any risks associated with the models, and hence, be able to fully benefit from the models that they're going to use.
Thank you, Sahel. So for a year, on one hand, you have a development challenge. On the other hand, you have the application challenge. And so, Andy, can I have a comment from you on how do balance this twin challenge from models and the governance perspective, please?
Well, there's no right answer, right? So I think back to John's earlier point, it's about resourcing this whole thing properly. Having a plan in place, having the right people in place, and resourcing it. So, I don't know if the results of the poll are in yet, but maybe we should show the results of the poll. Paul, is that possible, or Mary?
Okay, and the poll, is everyone on the poll? Maddie, please. Can you show the results?
Just a second.
Okay, that'd be great. I think that'll help us, maybe fine tune the conversation a little bit. But I suspect that all of the above will be the answer that we'll see most of.
Yeah, we have 9 votes for all of the above.
Wow.
Yeah.
And
so
1 for lack of in-house mode of validation.
Okay. Can you put it up on the screen, or is that not possible?
I think I turned the option show everyone the results. So probably if you click on the poll, we will be able to see it.
Yeah, I can see that. Yeah. We have,
okay, hang on a second. There we
yeah.
go. All right. Anyway, the point is that that all these areas, are a problem, are an issue, and from my perspective, again, the process of getting from where you build these models, you test them, and you continuously upgrade them to the point where they're mature enough so that you can have independent validation of the whole process on a regular basis becomes a real challenge from a resourcing perspective. Small organizations are not built to have, day-to-day, week-to-week, month-to-month validation processes built into these things unless it's automated. And this comes back to, I think, John's point about making sure you're using the best technology possible. So from that perspective, I think the most important thing to do is to identify those models that are critical to the operations of the institution. So John, we were talking the other day about this. There's organizations that have hundreds, thousands of models. So the question when I'm sitting on a boardroom table is, what are the 5 or 10 key models that we use that we absolutely have to get right? And how do we know as from a director's perspective and maybe management's perspective that they're properly being looked after, validated, and so on? So that's the way to do it. It's priority. It comes back down to risk. And so if your risk appetite is tight, then you should be validating all your models on a regular basis. That's what regulators would expect. But if your risk appetite is in the moderate zone, especially in certain areas, you might not want to spend the resources on that. So I'm not sure that helps, but John and Sahil may have different perspectives on that as well.
How many comments?
Yeah. Post 2008, we've seen the rollout of IFRS 9 models. We've also seen increased emphasis on stress testing. And these are not simple models. You know, as those of us who are involved in using IFRS 9 and expected credit loss models, we do know that these models are not easy to validate because they're what we call they use multiple parameters or multiple variables. What is required there is for organizations to really invest in-house and develop something called challenger models to be able to understand whether or not there is some possibility of cross-validation. When we move into the stress testing regime, and John would, of course, being in the US, he has a better view of that, but we've also worked on CCAR and DFAST-related capitalization requirements and so forth. So when we move to the stress testing regime, this becomes even a more complex problem. Just to give you an idea, a simple large bank with over $250 billion in assets can end up using thousands of models for its credit and capital related decision making process. And the scale of this problem is not just limited to the content expertise, but the scale of this problem is also complicated by the requisite staffing, by having the right FTEs in place to undertake the validation, and the right budgets in place from the perspective of second and third lines of defense. And when we look at the second line of defense, which is really the model validation line, which works under the CRO, and the third line of defense, which is essentially the internal audit line, and then you can draw up another line, which is really the independent external model validation line. So we've got this whole team of people which is involved in validation process. If you were to think about the resource requirement which is needed to validate over 2,000 to 3,000 models, we estimated that we are looking at over 7,000 FTE hours, you know, in any given year. And these FTE hours essentially imply that this is a very manual, this is a very hands-on type of role that needs to be completed. And I'm not really including in this equation the model governance regime, you know, and the riskiness of models that Andy has just pointed out. So unless there is an automation framework or an automation tool which is in there, which would assist the second and third lines of defense to conduct the model validation on an automated basis, we can see this to be a continuous problem that financial institutions are likely going to face over the next few years to come. And of course, I haven't seen a robust regime of validation for IFRS 9 models. I have not seen here in Canada, of course, and within the small to medium organizations. What we are seeing is that there's an ongoing application of these models, which is essentially waiting for another 2008 to happen so that we would find out that the models that we actually used were not right, you know, and that's really an unintended consequence that, you know, we are sort of lurching towards.
Yeah, if I could just pick up on that last point you made, Sohail, I think you're absolutely right. And you know, part of the challenge with the current situation that we're having is the models that were developed post 2008 were developed for a certain scenario, and that's not the scenario that we have today. It's a completely different scenario. And so now the model developers have to go back and think about whether or not what we're experiencing today has been covered by the models that they built for that kind of scenario. And it's going to be very interesting to see the next year or two as to whether or not IFRS 9 is a good example, whether that actually plays out the way they think it's going to play out. I don't know, maybe John, you might have a view on that as well.
Yeah, you know, and another item that I've noticed too, Andrew, is sometimes the macroeconomics that you're choosing for your models or you're basing your models off of, sometimes it's not the best performing model that you're after, but maybe the second best performing model. What I'm saying is sometimes you choose a macro that's not related, and it's very difficult for a model user to explain what the model's doing. And I've noticed that sometimes, you know, people are sacrificing a little better performance with a model they can't explain. And I've noticed that's been happening too since 2008. You have a model that gives you a 2% better result, but the problem is the business doesn't understand how that model is working anymore because maybe you're using an auto macroeconomic variable instead of a GDP. And it's very difficult for the business line to kind of explain that model. For a slightly less performance, they might have a better model that they can interpret better and understand better, which would make it more usable in an environment that we haven't seen yet, as opposed to something that that we have seen. And I'm seeing a lot of that happening now.
Yeah, I think the next 6 months to a year will tell us a lot about how robust these models have been and whether or not they can be changed. The macroeconomic scenario that you talked about can be modified to account for what we're experiencing today. You're absolutely right.
So we're looking at that in the demand side. What are the challenges on the supply side here? Like, any further comments on that?
Sure, I'll take that. So, over the years, we've seen a number of regulatory influences. I think Sohail mentioned IFRS 9, then there's 13, there's 15, there's 17, there's the trading book fundamental review, and other regulations. These demands, are requiring more in-house resources. It's increasing the number of models and the ability of people to achieve good, consistent, robust validations, which is causing an increase for more outside validation. Additionally, in-house, the increase in models, the increase in regulation can get extremely expensive to kind of manage that in-house. And again, this is pushing for a growing number of vendors, to meet these demands. And what it's also doing, though, is it's pushing the vendors to become more efficient and more accurate in the way they do their model validations. Vendors are having a lot of challenges in companies with outsourcing. It's not as so straightforward. There's, as we mentioned earlier, there's a lot of proprietary nature of banking models, which makes it very difficult for vendors to do their work. A lot of the vendors are very specialized in certain areas. If you have an ALM model or you have a certain credit risk model, they're not always as efficient with doing one model validation versus the other. So you've got to be careful for that challenges. So not every vendor has the right skill set for the models that they have. Example, might be a derivatives model versus a credit modeling. They both are vastly different, different inputs, different methodologies, and not one person can service this. And I think what this is doing is, this is kind of pushing the industry towards more of a machine learning solution. One of the problems that they're having also is there's a huge influx of data that that go into these models, and I think that some of these vendors are overwhelmed and need to move to more of a machine learning. There's a lot of issues with inputs and outputs that the models, some of these are indecipherable because of their size and complexity, and I think the only way they can handle it is through more of a machine learning type of validation. When I look at mid-level banks, they're unable to allocate a lot of resources towards machine learning tools for in-house validation. So it does make it, a better choice maybe to move towards a vendor who, takes advantage of multiple models that they're working on to allow them to hire the people to become more of a specialist in this area. So I see a need for the in-house to kind of push more of this to out-house, and a lot of that specialty will probably reside out-house with these vendors.
Exactly.
Thank you so much, John. Andy, Sohail, any comments on that?
Yeah, I'd like to jump in, and actually, I personally think that what John's described is really the right way to go forward. Although we have not seen a huge sort of rollout of offerings from a lot of vendors with regards to automation of models validation, but thinking about it from the perspective of a mid-sized financial institution, and that's really the sweet spot from BBA's perspective. So what we're trying to do is we need to be able to develop a framework or a solution that addresses the model validation journey from a holistic perspective. And when I say holistic, we talk about model governance here. So who owns the model risk in the organization? What kind of, as Andy pointed out, what are the sort of, what is the definition of a model? How we can actually create a model registry within the organization? What is the frequency of model validation that needs to be undertaken based on the relative riskiness of the models, as Andy pointed out, and that's what the board members want to know. And then, of course, we have a user journey from a validation perspective, and then we have a reviewer's journey that we need to be able to understand that when the model results are published, how are they reviewed? What kind of ranking the relatively risky models are assigned? And is it within the acceptable threshold with regards to the risk appetite of the organization, or is it outside that threshold? And what is the trade-off? Because a lot of the times, as you know, that we all become subject to an inherent inertia. And if we see that a model is doing great and the line of business is very happy with the model, notwithstanding it hasn't been validated for several years, then, of course, the status quo would demand that we do not make any change to that model. And that could in itself be a self-defeating proposition. So from the perspective of designing and developing a model validation solution and creating an automation within the organization, I personally think that this would have a significant and profound impact on not just creating the efficiencies, but also trying to sort of reduce the operational errors associated with the models themselves.
Thank you, Sahel.
You're welcome.
Well, I would, just to add on to that comment, I think that from a governance perspective, and I'll sit in my director's chair here for a minute. I think all the things that we've talked about here are going to be critical going forward as things get more complex, given the circumstances we're finding ourselves in. And I think the onus will be on boards of directors and senior management to ensure that the validation processes that are put in place give everybody comfort, the governance process works properly, and the oversight process from the regulators will also help in creating a level of comfort in this area. So I think it's going to get more complex, not less, and I think there's going to be higher demands, not fewer.
Great, thank you so much, Andy.
Hey, Andrew, let me ask you a question on this topic. So if you have maybe 100 models and let's just say 40 of those models are non-material, that they touch very few dollars and very little losses. But let's say the 40 models add up together to about 20% of your losses. What you're on a very low threshold for validation. You might be on a 3-4 year process here. How do regulators look at that and say, well, you've got a significant amount of your losses possible due to these, very small models that you're not validating too often? How's that perceived?
Well, John, regulators are not particularly interested in efficiency or effectiveness. They're more interested in effectiveness. So if it's going to cost the institution, more money to do the validation on all the models that they think are relevant to getting validated, then they're going to ask you to do that. They're going to demand or ask you to do it. Their demand is usually an ask, by the way, or a suggestion or a recommendation. But realistically, that they'll say, you've got X number of of your business tied up in these models. You've got to look at them. You may not have to look at them every year or whatever, and maybe you want to prioritize the validation process, but you need to look at them. But a smart organization, and I sit on the board of an organization where one of our very minor models, it was a minor area, we thought, was a minor area. There was an error in the model. And it was just a spreadsheet system that was developed, who knows how long ago, years and years and years ago, that did a calculation incorrectly or missed something. But the cumulative effect of that error over 15 or 17 years, if I recall the numbers correctly, or the timeline, became significant, and it became material over time. So even in those model areas where you don't think there's a lot of materiality,
Sure.
A cumulative error can make a big difference down the road. So at the end of the day, it costs us money. It would have cost us, 100 times less if we had done a validation process, picked up the error and fixed it from day one, then 17 years later find out that you've got a problem of that magnitude. So,
Sure.
To pick your poison, I always say from a regulatory perspective and from a management perspective, senior management and a governance perspective, the dollar you spend today will be a lot less than the dollar you may have to spend down the road if you didn't do it.
Yeah. Thank you so much, Andy. We have a question from Antoinette. I think we'll address all the questions in the end. If anyone else have questions, please put them in the chat or email me with that. Using that as a segue, what would be then the key functionalities of an automated validation system? What does that system need to have, in your opinion? So how we can start with that?
Great. Well, thank you so much, Paula. So I think one of the key, some of the key attributes of a straw man solution for an automated model validation system are essentially covered in three broader dimensions. The first is around data. So as everyone knows, that model validation is a data-heavy exercise. So in terms of data ingestion and data import into the application itself would be a challenge. So a lot of the times, I think, there are potentially data solutions that are available relating to API-based data uploads or CSV-based data uploads, or even an integration with the system at the organization. So that could be a slightly time-consuming, but these two that I mentioned earlier are very important. The second important functionality for a great model automation system is its workflow and integration of the workflow with the model governance process. So as you know, that model governance process is not just limited with regards to the model testing, but it also includes the concepts relating to model development, ability to understand the validation at the time of development and making a record of that, understanding that the three important likely errors with regards to model validation are addressed at the time of model development. And those errors are around ability of model to discriminate good versus the bad borrowers. So the second one is around the accuracy of the model, which is it is calibrated. And in terms of its calibration, it is calibrated on an ongoing basis. The third is around stability, which can technically be referred to as an overfit error or an underfit error. So the data that was used at the time of development, its relevance on an ongoing basis. So the important concept is that the tests are designed around addressing these three dimensions that the regulators are looking at on a regular basis. So that's the sort of the testing module or the testing kit. It is, of course, very technical and challenging, and you need really an expert to be able to, or an expert firm to be able to actually develop those tests for you. And the third dimension is really sort of creating a model registry or a model inventory, where you're able to actually log in the models, understand their application, and make a record and assign them the ratings. And quite frankly, where I see this entire model validation and model risk management is going is that institutions will be asked to actually set aside capital for model risk management. It is not being done at the moment, but now we have content, we have expertise available for those of you who would like to actually go in and dig deeper. There is a Wasserstein approach, which allows us to actually sort of identify the relative fit of the model and the model error, and to be able to actually identify whether or not, to what extent we need to set aside capital relative to the risk profile of the organization. So these are some key attributes that I think are important. By the way, I would also sort of include a comment here that BBA has secured the funding and the resources to develop model validation. We're calling that Model Tech Platform, and we're also interested in working with the Canadian organizations who would like to pilot with us and be able to join us on this journey. And we're very thrilled that, our model tech platform will be rolled out in 2021. Thank you, Paula.
Thank you. Any comments, John, Andy, on the key attributes of functionalities for the model system?
Yeah, I think just to pick up on Sahil's point about the setting aside the capital, I think that's a real likelihood going forward as regulators, and both at the international level and certainly nationally in Canada and provincially and so on, start understanding that the risks associated with these models could be significant enough to affect capital. I think you're going to start seeing some talk about setting aside capital for model risk, and I think and quite frankly, I think that's a great idea because that'll force institutions to take it seriously.
And using those modelings, they can understand what they're doing better too. So it's not it's just for the regulators. I think it's a win-win situation for all. Once they they can wrap this their minds around the fact that something has to change in that way. John, any comments?
No, just to reiterate, one of the things that Sohail mentioned is I noticed that lately there's been a big push to integrate the development cycle with the validation cycle, with the calibration cycle, more of a live, ongoing dynamic. I've noticed that's been a big push lately.
Thank you so much. We're going to go to Antoinette's question. She asks, is it possible to leverage BBA modeling tools and services to create the venue for collaboration among competitors, like model share ecosystems? She says.
Paula, can I take that? Thank you so much, Antoinette, for this question. I think it is a great question. Where we are with regards to our journey is that we're essentially in the process of developing these automated applications. As I said, 2021 is a great year for us. We're expecting to complete model tech and also the cyber application, which we're calling the Cyber 360. With that being said, our next stop is really developing an API-based functionality where we would like to actually allow the develop an ecosystem, not just with the other vendors, but also with those institutions who do not need a full-blown model validation system or capital management system, and they can just use that service only for that particular instance. So, our future approach with regards to undertaking these data-heavy challenges is to set up APIs and work in collaboration with our potential clients and make the affordability not an issue, make it a non-issue from a client's perspective, so that these dynamic analytics are available to our clients, and it is not a constraint or a taxing for their budgets. So that's sort of the our approach, and fingers crossed, you would probably want to see that happening in 2022 or 2023 timeframe. But that was a great question. I also want to send a big shout out to my colleagues from ex-colleague from Oliver Wyman. Mark Paskowitz is joining us today. Mark, I know it's late in London, but thank you so much for being here today, and it's great to see you on the webinar.
Thank you, Sohail. Well, I take the opportunity to say thank you to everyone. We have people joining us from really all over the world, from Indonesia, from London, from other countries, Arab countries. So we're probably will change the time of the webinar because we have so many people in different time zones in front of us. So that will probably change. At this point, I think we only have 1 minute, so I'm going to thank our audience for taking the time to join us today. Thanks, John, for being our guest of honor today and participating. Big thank you to Andrew Kawa, our senior advisor, and to Hal Farouk, our CEO, and also for Mariana Nadai from our marketing team. And we'll be in touch. Well, next episode is going to be in July. So it's going to be reimagining the branch one brick at a time. So I hope to see you all then. And if there are no other questions, this concludes this webinar, 6 p.m. on the dot, and Toronto time. And if you have any questions, please, I'm going to share our Okay, here we go. I'm going to share our contact. I'll leave that up. So there we have it. And also contact at bba.to if need be. And we look forward to seeing you on our next webinar. Thank you, John.
Thank you all.
Thank you, Suhal, and thank you all the participants.
Thank you so much, everyone.
Take care. Stay
Bye-bye.
safe.
Thank you. Bye-bye.
Thank you.
Bye.
Bye-bye.
Bye.
Bye. Bye.